understand, I think, why people might want to sell off the banks. I understand to a degree why they might want to sell off the technology companies. But why are they selling everything at the moment?
Good morning, Steve. Well, I think there's a positioning issue, maybe more than a fundamental issue here. So I think that the perfect storm that hit the market is very much about soft macro. We got a pretty weak ISM yesterday, soft earnings. We had fairly unexciting Q2 numbers, and there's a bit of a liquidity issue with the unwind of JPY carry trade. But I think all this is being exacerbated or amplified by fairly high positioning. And we wrote a report earlier in the week to say that there was a little bit of cleanup in position in July, but not much. We had a lot of money going to the equity market in the last few weeks, in the last few months, from institutions, from retail, and a lot of this money has gone into cyclicals. And I guess what we are seeing now is a bit of indiscriminate selling. People are, selling first and thinking later, in the backdrop of very weak summer liquidity and very low attendance, because a lot of people are just not here and on holiday.
So that makes it fascinating. If there is indiscriminate selling, maybe not quite baby in the bathwater, but certainly selling across the board, that is one of those exciting moments that gives people like you in equity strategy an opportunity to say, okay, they're selling everything, but you shouldn't be selling this. Or if you are selling everything, maybe you want to have a think about this is your next purchase rather than sale. Where are those opportunities, Emmanuel?
Look, I agree with that. So, look, firstly, we've been reducing our risk early in the summer. So we reduced our position in Japan, in Europe, in cyclicals, went back to bond proxies, on the view that a lot of good news were priced in, and that we were going into a bit more tricky time of the year with, pre-election volatility, and we were seeing some red flags in the economy. So we are somewhat prepared for a bit more challenging market environment. But as you said, Steve, I think right now I would not give up on everything, and I think this kind of thing can give or provide some opportunity. So we still like the banks, for example. I get the point that banks are very well owned, definitely. So there is a risk there. But earnings have been pretty good for the banks. We don't see rates collapsing in Europe. We don't see the economy collapsing. So that could end up a very good buying opportunity for the sector. But I would just wait for the dust to settle to start with. There is no point to rush. You want to see the data. You want to see how the fundamentals will evolve. And I think the payrolls report today will be very important. I mean, bad is bad in this environment, but good is good as well. So we need some fundamental backstop to this market. We had the Fed this week, where the ISM, where earnings, where a lot of catalysts have played out. We are left with the payrolls as a next big thing, and probably payrolls today will or hold the fate of the market maybe for the rest of summer. So if hard data delivers and doesn't show too much weakness, I think that might be helping this market to find a floor and maybe some deep buyers to step in. But I will not rush. I want to see how the data evolves before stepping in and buying some of the oversold names that we like.